Good afternoon, everyone. We're excited to speak to you today about a couple different topics. We're going to cover, as Shannon mentioned, deductions and exemptions first, and then we're going to move into Gateway Abstract. Gateway Abstract is a project we've spoken about at these conferences, probably 3 different conferences now at this point, and the project's progressing really well, and we're excited about it. But of course, we have important material to cover before that too. This used to be in Mike Duffy's wheelhouse, for those who have been around for long enough. He was our deductions and exemptions expert. Mike left us in the spring, so we're taking over his material. I did want to do one introduction, and actually, I'm not sure if I see him. We have a new general counsel who joined our agency the same day that Wes did, so about 6 weeks ago. So over in the corner here, this is Dan Shackle. Dan has prior experience with the Attorney General's office and with the city of Indianapolis, and is ramping up in a hurry on local government matters. He's going to be a great resource for the agency and for all of you. So I'm going to do my best to do this in Mike Duffy fashion, in spite of the fact that he and I are very different from each other. And one thing that I noticed after submitting these materials, but after actually sending the email in saying this is what I'm going to use, if you have a copy printed out, you may notice down in the bottom corner we have a date, January 20th, 2007. So what that tells me is that people have been updating the same version of this presentation for over 10 years now. So it may be a little repetitive, but I also thought, and I'll be very quick about this, it might be kind of fun to take a walk down memory lane and find out some of the interesting things that happened in 2007. So I think you guys are going to like this. February 4th, 2007, the Indianapolis Colts beat the Chicago Bears, win the Super Bowl. I apologize if we have folks from the region that are Bears fans. In April of that year, the Dow Jones crossed 13,000 for the first time, and actually peaked at over 14,000 that year, and then got to its lowest point a few years later, just over 6,000. And as of the end of the day yesterday, it was over 23, so big roller coaster, but 2007 was an interesting year for that. Bob Barker hosted his final episode of The Price is Right. Barry Bonds broke the career home run record. Yeah. And the Writers Guild, we remember the Writers Guild strike. That was a pretty big deal in TV. That was also in 2007. So with that said, we'll go ahead and actually get into the material now. We're going to cover a lot, and we're going to do it pretty quickly because we have several different things to cover between this and Gateway Abstract. So I'm going to move quickly. I'll stick around afterward to try to answer any questions that I can, and then we're going to put together, we've received a lot of questions over the last couple days. We'll put together a Q&A kind of document and post it on our website over the next week or two. So if we don't get to something that you want to talk about that's related to deductions and exemptions today, or credits, send us a question or catch me afterward, and we'll make sure that we get that posted on our page. So some kind of basic definitions. A deduction reduces assessed value on a parcel. Exemptions are used to identify property that's exempt or is excluded from assessment altogether. And then we have credits, which are an actual reduction to the tax bill itself. We have a disclaimer that we need to offer, and we're probably offering this every time we do this presentation. This isn't a substitute for the law. The law always controls. If you have questions, you should be sure to go back to the statute. And something else that I actually should have put in here is when it comes to deduction and exemption questions and credits and tax bills, we also encourage you to engage your county attorney. Ask them questions about their interpretation of the statute if there are things that you're unclear on. And of course, we want to serve as a resource for all of you as well. So on the board, we have a relatively common net AV equation. We're looking at what would perhaps be a typical homestead where you've got the gross assessed value on 1% property. You have an applied homestead deduction and a supplemental homestead deduction. And in many cases, for a taxpayer like this, we'll see a mortgage deduction. So just a common example as we look at how to calculate tax bills of what the top portion of the bill is going to look like. We also have a few important deadlines, and I know this is highly important to your offices. Deduction applications have to be filled out and signed by the end of the calendar year prior to when the taxes are paid. They have to be filed or postmarked no later than January 5th. So we're going to take a look at some common deductions. We're not going to get through every deduction and exemption and credit, but we're going to go through a lot of them, and we'll go into some detail on some. Homestead deduction is the lesser of $45,000 or 60% of the gross assessed value of the homestead eligible property. The homestead deduction applies to the dwelling itself and up to 1 acre surrounding the property, and it has to be the principal place of residence for the taxpayer. So the applicant for a homestead deduction must either own that property or be buying it under a recorded contract that provides that the buyer is responsible for paying those taxes. Supplemental standard homestead deduction applies to the net AV after you apply the homestead deduction. It's equal to 35% of the net AV if the net's up to $600,000, or 25% after that point. And one thing to clarify on the slide, we're looking again at the portion after the homestead deduction itself has been applied. Mortgage deduction. Mortgage is, we often see it come in at $3,000. That's the most common case, but it actually has 3 different amounts that it can be. So it's $3,000 or the balance of the mortgage, or 1/2 of the total assessed value of the property. And there are some interesting cases around the mortgage deduction in terms of taxpayers that can receive it. It is possible for a taxpayer to have more than one mortgage deduction. It's not going to be more than one mortgage deduction on their homestead, for instance, but if you have a taxpayer who has a mortgage deduction on their property and is also a business owner with a mortgage, they can receive a mortgage deduction on both of those individual tax bills. A few notes about the mortgage deduction. There's not a minimum in the standard for what it can be, but again, the deduction itself is capped at the amount of the mortgage. And so it's also available for a property on which a person has a home equity line of credit, as long as that's been recorded in the county recorder's office. So there were a few changes to the mortgage deduction and some key terms around it from the 2017 legislative session. One thing that's been a challenge that you all have helped our office identify over the past several years is exactly how the term mortgage is defined, and installment loan for that matter too, as it pertains to mobile properties in particular. So during this past session, we worked together with the legislature to try to put some parameters around that. And so on the screen right now, we have what those definitions actually are. In both cases, it especially on the mortgage, it deals with a lien against property where the borrower provides that lien to the lender. Importantly, the term also includes a reverse mortgage. So if you have questions that come into your office about whether something does or doesn't qualify for a mortgage deduction, especially if you receive those from this year moving forward, I'd encourage you to check out the statute because there's a little bit more definition in there than what we used to have. The over 65 deduction. So we have, when it comes to taxpayers who are over 65 and meet certain other qualifications, we have both a deduction and a credit that they're potentially eligible for. The deduction is equal to the lesser of 1/2 of the gross assessed value of the property, or $12,480. And of note with this particular deduction, it can zero out a property tax bill, and we see that. The applicant has to have owned the property for a year prior to claiming the deduction. And then there are income limitations. So it's $25,000 income for the deduction. And then there's also an assessed value cap on this one, $182,430.
Can you clarify on this? Because it can be read a couple different ways. If you have an older couple, of course, if they're going to be getting the age exemption, but just has their child on the deed, just to have it on there in case something happens to them, do you have to include their income on that if they do not live with them? This is kind of you can read it a couple different ways.
I'd want to go back and take a look at the statute. I'd hesitate to answer that here in person. But let me take down a note for that, and we'll check it when we get back to the office, include it in our Q&A document. So on the over 65 deduction, there's more around it, of course. The applicant has to be at least 65 by the year preceding the year in which they're going to claim the deduction. The same person who has an over 65 deduction, they can also receive the homestead, the mortgage, and the fertilizer storage deduction. But when it comes to other deductions in the tax code, there are restrictions around it for whether somebody can have both over 65 and the other deductions. It's important to note that the deduction can't be taken away from a taxpayer if they're away in a nursing facility, for instance. Yeah. Okay, and then we've got the over 65 circuit breaker credit, which is different from the deduction. Again, a deduction reduces the assessed value on which tax rates are going to be applied and taxes are ultimately going to be calculated. A credit reduces the actual amount that's owed by the taxpayer. So for certain taxpayers over the age of 65, they can be eligible for a credit. And the gist of it is it's designed to protect the taxpayer from having his or her tax bill increase by more than 2% year over year. So just like with the deduction, there's also income and assessed value restrictions on this one. It's $30,000 income or $40,000 if married. Gross assessed value can't exceed $160,000. And so basically, if there are no improvements to the property that change it over what it was before, and they meet these other requirements, their tax bill is not going to go up more than 2%, regardless of what the tax rates in their taxing district do. The blind and disabled deduction, the deduction amount for this one is, or for these deductions, is $12,480. The taxpayer has to use the property on which they're claiming the deduction as their principal place of residence. They must own it or be buying it under a contract. They have to provide proof to your office of the disability or of the fact that they're blind. And there's also an income limitation on this one. Again, I apologize, we're moving quickly. We have a lot of material to cover in a short amount of time. Heritage Barn, this one is relatively newer. Heritage Barn pertains to a property that was constructed before 1950. In substance, the barn has to retain its original features. It still has to serve as a barn, and it can't be a homestead. It can't be a dwelling. And there's some really specific items in statute that describe what qualifies and what doesn't qualify as a heritage barn deduction. One thing to note on this particular deduction is the amount of the deduction is designed to be applicable to the improvement itself, so to the heritage barn, which means we shouldn't see a heritage barn deduction applied to a taxpayer's 1% assessed value, for instance. It should be applied to the actual barn itself. Okay, deduction dates. We run into this issue commonly for folks that are homeowners and are moving in a given year. The rule of thumb is if a deduction is in place on the assessment date, it sticks. So that deduction remains on for the following year's tax bill, but not for the year after that. So we do have cases where an individual had a homestead deduction on a property that they're vacating, and then they buy a new property, and then through the sales disclosure form or through the homestead deduction application, they'll claim the deduction again, and that's okay for sort of the 1 year transition between their old property and their new property. But the same applies for other deductions as well. If it was in place as of the assessment date, as of January 1st, that remains in place for that taxpayer's bill. I don't know. The question was, if it was in error, if it was on an error, can you remove it? I don't know the answer offhand, but we'll check into that too, and we'll let you know. For deductions, especially deductions that pertain to a place of residence for a taxpayer, it is important to note that they have to use the property as their principal place of residence for the year that the deduction application or the SDF is signed. So there are a ton of questions that come in about deductions and exemptions, and you all field, I'm sure, 10 times or 100 times more of them than we do, but we get questions on deductions and exemptions daily. So common ones can pertain to, for instance, the over 65 deduction. The question, can one spouse or owner receive an over 65 deduction while the other spouse or owner receives a veteran deduction? The short answer to that one is yes. One person can receive the over 65 deduction, and another person within the same homestead or within the same married couple can receive a veteran's deduction. This slide that we're looking at now pertains to the pink forms. So now we're going back 5+ years. A handful of years ago, there was a process through which county auditors contacted the folks in their counties that were claiming a homestead deduction and went through a verification process to see that the taxpayer still lives there and is still eligible for the homestead. And then over time, we saw county auditors, as they were permitted to do through law, remove homestead deductions for folks who had not returned that form. The law is still there. The process is still in place. I don't think there are probably a lot of counties that are still in this position, but if you are, the law is still there. If you end up removing a taxpayer's homestead deduction because they didn't return the form, and then they get back to you and in fact prove that they were eligible for a homestead deduction, the county auditor is supposed to actually go back and apply the homestead deduction for the taxpayer. So Bob from Tippecanoe County and I and Dan were speaking about this particular case right before we came on for this presentation. We're dealing with a situation here where you've got two different individuals who own a property, and one of them uses it as their homestead and one of them does not. In that case, the person that uses it as their homestead is still permitted to claim a homestead deduction, and nothing precludes the other owner of that property from claiming a homestead on a different property, so long as the other property is actually their true permanent residence or their principal place of residence. So these kind of questions do come up if you got a brother-sister dynamic or other situations where you'd have more than one owner on a property and only one using it as their homestead. That said, if you've got two or more people that own a property eligible for the homestead deduction, only one homestead deduction can be applied to the house. And so what this means, we wouldn't expect to see a tax bill that has homestead deduction 1 and homestead deduction 2. And I don't think we have cases of that around the state, but it is an important thing to note when we're dealing with multiple owners. We receive questions frequently, and I imagine that your offices do too, about the types of identification that a taxpayer has to provide if they're claiming a homestead deduction. By default, what we normally see is that the last 5 digits of the Social Security number are provided, or in place of those, we'll be looking at the last 5 digits of a driver's license number or the last 5 of a state ID. And there's a series of options that folks have for the kinds of identification they can provide to your office when they're claiming a homestead deduction. One thing that's especially noteworthy for those who are moving to Indiana from out of state, the individual is supposed to obtain a driver's license within a couple months of moving to the state, but that doesn't necessarily preclude them from claiming a homestead deduction on their property. So if they do this kind of out of order from what we might normally expect, they still could be eligible for the homestead deduction. Changes in marital status and the homestead deduction, these are certainly common cases. If a couple is unmarried and they receive a homestead deduction, and they become married, they're supposed to reapply for the homestead deduction with your office. And if the opposite case happens, if you have a married couple that divorces, they're also supposed to reapply for the homestead deduction with your office. Along similar lines, we've got cases where an over 65 deduction, so if a taxpayer is receiving an over 65 deduction and their situation changes in terms of who lives in the household or their marital status, along similar lines, they're supposed to come back in and reapply for the over 65 deduction with your office. Several of these deductions, the deductions in particular, do have income requirements, and so a question that comes up is, what's the auditor supposed to do? How do they verify what the income of the taxpayer is? So for the over 65 deduction, the taxpayer is supposed to provide evidence to your office of what their income is, and most of the time we're going to expect that to be their income tax return from the prior year. The same situation applies with the over 65 credit, where again there's the $30,000 and $40,000 income tax threshold. We'd expect for your office to be able to collect the prior year income tax returns to verify what the income of the taxpayer is. So we have this slide that's been carried forward for several years, and the reason that we keep it over time, in spite of the fact this is legislation from 2012, is we do think it's really important, and that's it deals with a taxpayer for which your office has determined they're no longer eligible for a homestead deduction. So if the taxpayer has been notified they're not eligible for the homestead deduction because it's not their principal place of residence, the owner is able to appeal to the PETA-BOA to have that deduction reinstated. As a county auditor, if you go through the step of removing the homestead deduction from that taxpayer, you're required to notify the taxpayer that they do have that option where they can go back to the PETA-BOA and try to appeal the decision. So again, this is one that could get kind of touchy with the taxpayer, especially if you're removing deductions. So if you do, be sure that you notify them about their PETA-BOA options. 1450 from the 2017 legislative session, this was a Representative Leonard bill. It provided some new requirements around individuals who are receiving the homestead deduction. And what it pertains to is a case where a taxpayer was previously eligible for the deduction and no longer is. The taxpayer is now supposed to notify your office when they're no longer eligible for a deduction. And if they don't, then there's now an option in place for the county auditor to, once they've discovered that a taxpayer was no longer eligible for a deduction, there's a mechanism in place where the county auditor can require back taxes for the years in which the taxpayer claimed a deduction and should not have been eligible. The question was, is there a time limit on how far back you can go? I don't know, but we'll check into it for you. Okay, the one-year carryover. This also became effective on July 1, 2017, so this is the law of the land now, but still relatively new. A person who failed to apply for a deduction or a credit by the prescribed deadlines is not allowed to apply for them retroactively. So this is going to actually differ from something that we're going to cover on exemptions toward the end of my portion of the presentation, but it deals with deductions and credits in particular. So basically, if the taxpayer has missed the deadline, they can still fill out the deduction form or the credit application and if that applies, but it's going to be applicable to the following year. It's not retroactive. For purposes of the mortgage deduction, if a taxpayer refinances their mortgage, they're instructed to reapply for the mortgage deduction. And then importantly, before a county auditor terminates the deduction, this is going to be one that's important for the taxpayer in this case. The auditor is required to notify the taxpayer of that decision to remove the deduction. You have to do it in writing, and you can do it either through email or through traditional mail. So basically, I think the idea behind this was just to provide an option that's friendly to taxpayers to make sure they recognize what's going to happen for their tax bill in the following year. Okay, we're going to start to cover veterans deductions. We're about halfway there on deductions and exemptions. Okay, Partial disability. The partial disability veterans deduction is $24,960. A taxpayer qualifies if they meet a handful of criteria. And to qualify for this one, they have to have been in the military during a conflict. They have to have received an honorable discharge. They have to have a disability of 10% or more, and they have to provide evidence of that disability to the county. And then finally, they have to own the property or be buying the property under contract. An individual who receives the partial disability deduction is not eligible for the World War I surviving spouse or the World War I veteran deduction. We're going to talk about that one in just a moment as well, but you can't double dip on both the partial disability and the surviving spouse deduction. In addition to the partial disability, we also have the total disability deduction. This one is $12,480, and it has similar criteria for determining if a taxpayer is eligible. They have to have served in the military for at least 90 days, received an honorable discharge. They have to have a total disability or be at least 62 years old with a disability that's at least 10%. And one thing that's important to note is the law doesn't say the disability has to be related to their military service. They have to provide evidence, again, to the county that they are, in fact, a disabled veteran. And finally, they have to own the property or be purchasing the property under contract. The total disability deduction, this one has an AV cap. It's $175,000. And interestingly with this one, it's not just $175,000 on the homestead, but the deduction is specific to all of the assessed value for the individual taxpayer. So filing for the deduction, it has the same application dates as homestead and several of the other deductions that we've looked at. The application is due by December 31st of the year prior to when the deduction is going to impact the tax bill. It must be postmarked to your office or filed with your office no later than January 5th. For mobile properties, it has to be filed during the 12 months before March 31st of the year for which the individual intends to claim the deduction, and they can file it again in person or through the mail. And then again, we've got a series of requirements that the taxpayer has to provide to your office to verify that they are in fact eligible for the deductions. We've got listed on this slide the material or the evidence that the taxpayer can provide to you. So it's a pension certificate or a certification from the VA to indicate that the taxpayer is in fact an eligible veteran. Surviving spouses. So in addition to an individual who served in the military and is eligible for the deduction, once that individual passes away, their spouse remains eligible for deductions. And one thing that we note on the slide, and I think is an interesting part of this, is not necessarily the case that the property had to be owned prior to the veteran passing away. It's possible that the taxpayer has acquired more property in that time. But it is important that they were eligible for the deduction at the time that the veteran passed away. We also have statutes that pertain to spouses of World War I veterans in particular. This statute is being sunset because World War I was quite some time ago, but there's still spouse eligibility for folks who may have been married to an individual who served in World War I. Okay, and then we have a new one, and this one relates to veterans again. It's going to apply, I think, to a relatively small number of cases, but of course it's crucial that it be applied correctly for the cases where it is. There's a deduction in place passed, I believe, in the 2016 legislative session pertaining to donated homesteads for disabled veteran taxpayers. And there's a series of items that we're looking at, or that your office is looking at, to verify that the taxpayer is in fact eligible for this deduction. So basically the taxpayer has to have served in the military for at least 90 days, an honorable discharge. disability of at least 50%, with evidence provided for that disability, and then the property has to have been conveyed to that taxpayer without charge to the individual. And then the amount of the deduction is tiered, and it's based upon the disability for the individual who's going to receive the deduction. So if a taxpayer is totally disabled, then they're going to receive 100% deduction. If they've got 90% disability or more, but not quite 100, they're going to receive a 90% deduction. Between 80 and 90, they're going to receive an 80% deduction, and so forth. So again, this one is new, but it's obviously important that it be applied correctly for those who, in fact, are eligible for it. A veteran who claims this deduction is not eligible to claim the partially disabled or the totally disabled, and they have to fill out the state-prescribed form. We developed this form at the end of 2016, and it's available on our website if there's a taxpayer in your county that would like to claim it. And then we've got questions relating to the veteran's deductions. Can a veteran receive more than one veteran's deduction? The total amount of deductions can't exceed the maximum that's established by statute. So if a veteran owns more than one property in the county, they're eligible for the total maximum amount of the deduction. But it's not that they can receive the maximum amount on property 1 and on property 2. So there's a couple ways you can think of this. It's either that the deduction amount is being split among more than one property, or maybe they're receiving it on one property and not the other. But keep in mind that the deduction is specific to the taxpayer himself as opposed to the property. If two veterans own a property and both are eligible, then they can both receive the full deduction because the veterans deduction statutes speak to the individual rather than, again, to the property. And then finally, what if a veteran only owns personal property? Our interpretation of it is that personal property is in fact eligible, so the taxpayer can receive those deductions. Okay, that's a lot of material on deductions. So if I were Mike Duffy, with his really good dry sense of humor, at this point I think that he would probably crack an attorney joke or something along those lines. I'm an accountant, and to be honest, I don't think there are very many good accountant jokes out there. Though if anybody has one, I'd love to hear it, because let me know after we wrap up here. But in the spirit of Mike Duffy, I did want to offer one before we get back into our material. Did anybody in the room happen to hear about the koala bear that tried to make it into the Indy 500 last year? He did his best, but unfortunately, he did not qualify. Again, I'm not Mike. Mike's better at this, but I figured I'd try. Okay, so exemptions. Exemptions are going to pertain frequently to the assessor's office, every bit as much as the auditor's office. So we have less material on these, but we'll still go ahead and cover it. Going back to one of the first slides that we had up here, exemptions are different from deductions in a sense, in that we're dealing with property that's not actually eligible for taxation as opposed to a deduction, which reduces the assessed value on which the tax rate is going to be applied. When we talk about exemptions, we're frequently looking at churches or government-owned property, and then certain exemptions that are set up through statute. We've got the constitutional basis for exemptions. Most exemption language can be found in 6.1.110, but it is kind of scattered throughout 6.1.1. Okay. So applying for exemptions, we've got a state-prescribed form, it's again on our website, the Form 136, that a taxpayer will use to apply for an exemption. The deadline for exemption applications is different from the deduction application. It's due on or before April 1st of the assessment year, meaning for the 2018 tax bills, the deadline for applying for an exemption was the prior April 1st. When we look at 2019 tax bills, it's going to be by the coming April 1st. If a PITA-BOA decides to deny an exemption, they have until April 25th to provide that notice to the taxpayer. And then there are certain organizations that don't actually have to apply for the exemption. So for instance, if you operate out of a courthouse or a government-owned building, you're not filling out the exemption paperwork every other year. In most cases, the exemption form is filed in the even years, again, using the Form 136. There are a handful of exceptions for the types of taxpayers that don't have to go through the even year application process. So there were a few changes to exemption language in statute from 2017. This one again goes back to Representative Leonard's Bill 1450. And this particular language, it may actually apply just to a single taxpayer around the state, or at a minimum, a very small number of taxpayers. So we've got a new exemption that's on the books. If the owner is a 501c3, they're a federally qualified health care center or health center, and a primary medical provider that meets these criteria, and there's more. They've been granted an exemption for a comparable facility in a contiguous county, then they are in fact also eligible for this particular exemption. So again, likely just a one or two taxpayer situation. But I did want to point out something else that was new for exemptions this year, and this is going to differ from what we had on deduction and credit language. With exemptions, there is a process by which a taxpayer can apply for exemptions retroactively, and that's going to be using the Form 136, and they can file that for up to the 3 previous years if they should have been eligible for that exemption and didn't have it on their tax bill. So it's our interpretation that at least that this dates back to, we could see this apply to both 2015 and 2016 taxes. So if you do have a taxpayer who has exempt property in your county and they come to you and they approach you about retroactive application for an exemption, this is likely what they're referring to. Again, you want to look at the Form 136, and if you have questions about this particular process, we have a few folks in our office with a lot of knowledge on the exemption process, and we'd be happy to work with you on it. The retroactive period for which a taxpayer can apply for an exemption, it doesn't actually change the exemption deadline. But again, because it includes the May 15 filing deadline, in our mind, this does in fact become retroactive to 2015 and 2016 taxes. Okay, I know that was a lot of material, and we moved through it really quickly, and I want to make sure that Fred's got as much time as he can to cover Gateway Abstract, which again, for our office and for the Auditor of State and for all of you, is a really key project, especially as we move into the winter and the spring. I'll stick around for a little while after we wrap up,